Welcome to The Explainer. Okay, let's dive into this. Today, we're tackling a massive, absolutely crucial topic for anyone who has moved to Canada from India but still has financial ties back home. If you've ever felt completely overwhelmed just thinking about managing taxes across two different countries, you are in exactly the right place.
Still have investments in India after moving to Canada? Many Indian immigrants in Canada continue to earn interest from fixed deposits, dividends from shares, rental income, or returns from investments in India. Because Canada generally taxes its residents on worldwide income, that income may also need to be reported in Canada. The good news is that the India-Canada Double Taxation Avoidance Agreement helps reduce double taxation.
Part 1. The Double Taxation Trap, where you end up caught between two systems.
If you're building a life in Canada while, say, maintaining ancestral property or keeping an active investment portfolio in India, you are straddling two totally different tax jurisdictions. And honestly, that overlap is exactly where the headache begins. On one side, the Indian tax system generally taxes income generated right at the source. Basically, if the money is made on Indian soil, India wants its cut. But on the other side, Canada operates on a residency-based system. They tax their residents on their worldwide income, literally no matter where it's earned. You can instantly see how this creates a painful trap, right? Without careful planning, your hard-earned cross-border wealth could easily be taxed twice, taking a huge bite out of your financial future.
Moving on to Part 2, let's look at how the DTAA actually works. This is your mechanism for relief.
Thankfully, there's a formal solution to this jurisdictional tug-of-war. Back in 1997, India and Canada signed the DTAA, which stands for the Double Taxation Avoidance Agreement. It's basically a bilateral treaty that prevents duplicate taxation on the exact same income by allocating taxing rights and capping withholding rates. So the crucial point is, applying this treaty isn't some automatic shield. It's an optional legal framework, but let me tell you, it's usually your absolute best strategy to keep your money in your own pocket. Now, if domestic laws happen to be better for your specific situation, you can totally use those instead, but understanding and actively applying the DTA is absolutely essential.
The main tool you get from this treaty is called the Foreign Tax Credit, or FTC. This is a mechanism under Article 23 of the treaty where Canada basically grants you a credit for eligible taxes you've already paid to India. This directly offsets your Canadian tax liability. But listen, there is a super important condition to this relief. The credit is capped. It can never, ever exceed the Canadian tax you would have otherwise paid on that specific foreign income. Canada simply isn't going to subsidize a higher foreign tax rate. So here's the chronological workflow of how this foreign tax credit actually operates in real life. Step 1, you earn the income in India. Step 2, you pay the required tax to the Indian government. Then Step 3, when tax time rolls around in Canada, you report that gross income to the Canada Revenue Agency. And finally, Step 4, you subtract the Indian tax paid to figure out your net Canadian tax. Just keep in mind when you're doing this, taxes have to be pooled country by country, and you must strictly segregate your business income from your non-business or investment income.
Okay, Part 3, tax rules by asset class. Let's ground this theory in reality. Now that we have the theory down, we really have to look at how this plays out based on the exact investments you hold back in India, because different assets face completely different tax limits. And this brilliantly illustrates how the treaty works across the board. For NRO savings, or fixed deposits, India normally takes about 31.2% in TDS, but the DTAA caps that at 15%. For corporate dividends, India takes 20%, the treaty cap is 25%, but Canada limits your FTC to 15% on non-business property income. And what about rental property? Well, the DTAA says domestic law applies there, meaning India gets the primary taxing rights, and then Canada taxes it based on net rental income, letting you deduct your actual expenses. I really want to zero in on that 15% number for just a second, because this is where you can see massive real-world savings. Under Article 11 of the DTAA, the withholding tax on interest in India is capped at 15%. Guys, this is a huge reduction from the heavy 31.2% domestic Indian TDS that banks will just automatically deduct if you don't take action. Saving over 16% right at the source is a complete game changer for the return on your fixed deposits.
But what about capital gains? Well, this is where things get incredibly tricky. Under the Indian system, capital gains are calculated using the historical purchase price of the asset, what you originally paid for it maybe decades ago. Meanwhile, Canada calculates capital gains using what's called a stepped-up cost basis. This means when you immigrated, Canada basically treated your assets as if you sold them and immediately rebought them at their fair market value on your exact date of entry. This cost basis mismatch means India might tax you on 20 years of growth, but Canada only taxes you on the growth that happened after you arrived. Because the Canadian tax will be so much lower on that asset, you might end up with unutilized Indian tax credits that you literally just lose forever.
Next up, Part 4, the NRE account myth. Tax-free in India, but taxable in Canada.
It is officially time to bust a dangerous, widely believed misconception among non-resident Indians regarding a very popular type of savings account. The hard truth is this: NRE account interest is completely tax-exempt in India. However, the Canada Revenue Agency does absolutely not recognize this exemption. A lot of people mistakenly think that just because their NRE interest is tax-free in India, it's somehow tax-free everywhere. No way! Because you pay zero tax in India on this money, there is zero foreign tax credit available for you to claim in Canada. That means this interest is fully taxed at your Canadian marginal tax rate. Seriously, do not make the mistake of hiding this from your Canadian tax return.
Moving to Part 5, essential tax compliance steps. This is how you actually claim your relief.
Let's move to and see how this builds into an actual strategy. Because, as I mentioned earlier, the DTAA isn't some magical automatic shield. It requires very specific, actionable paperwork. To actually lock in that reduced 15% rate on your interest and claim your credits, here is your exact pipeline. Step 1, you must get a Canadian Tax Residency Certificate, or TRC, from the CRA to formally prove where you live. Step 2, you take that certificate and e-file Form 10F on the Indian Income Tax Portal. That legally tells the Indian banks to stop deducting that brutal 31.2%. And Step 3, you claim your foreign tax credit on Canadian Form T2209 when you file your taxes.
And whatever you do, please do not forget this number, $100,000. If the total cost of your foreign assets exceeds 100,000 Canadian dollars at literally any point in the year, you absolutely must file Form T1135, the Foreign Income Verification Statement, with the CRA. Missing this form is one of the most common and, frankly, most costly compliance mistakes you can make. The penalties for failing to file it can be massive, even if you don't actually owe a single cent in extra tax.
Another area where you really need strict compliance is with rental property. India allows a standard 30% deduction on gross rent for repairs and maintenance. It's super simple and automatic. But Canada? They do not recognize that standard deduction. On Canadian Form T776, only actual receipt-supported eligible expenses are allowed. You have to keep all those invoices. And remember, when you're doing your Canadian taxes, you must convert all these foreign incomes and actual expenses using the official Bank of Canada exchange rates.
In many cases, taxes paid in India may be eligible for a foreign tax credit in Canada, subject to Canadian tax rules. But remember, the DTAA doesn't eliminate tax automatically. You still need to report your income correctly and claim the available relief. Before filing your taxes, review your Indian investment income and keep your tax documents ready.
Now, what's really interesting about this slide is the core question it asks. Are you leaving money on the table by paying taxes twice on the same hard-earned investments? The tools to protect your wealth are right there in the DTAA, just waiting for you to use them. Take the time to review your tax strategy. Maybe consult with a cross-border CPA and make sure you understand exactly how your Indian assets fit into your Canadian life. You worked incredibly hard for that money, so let's make sure you keep it.